Silver just did something that normally takes years. In 60 minutes, it just smashed through $94 an ounce. 94. As I'm recording this on Monday, January 19th, 2026, spot silver printed a peak around $94.36, and I know what you're thinking. Okay, so what? Metals go up, metals go down. No, this wasn't a cute little rally. This was a market-wide flinch, the kind you see when something breaks behind the curtain. And here's the part that's going to sound insane until you connect the dots. This move wasn't driven by inflation charts or a CPI number. It was driven by Greenland. Yeah, Greenland. A geopolitical chess move just hit the silver market like a freight train, and most people still have no idea why. So if you hold physical silver, or you're thinking about buying, or you're just trying to understand what the heck is happening right now, do not click away. Because I'm going to walk you through the three forces that collided to push silver into the stratosphere, and then I'm going to tell you what I'm watching next, what could trigger a pullback, and what could push this into triple digits faster than anyone is ready for. All right, deep breath. Here's the headline reality. Over the weekend and into the last hour, President Trump escalated his bid to acquire Greenland, and he didn't do it with polite diplomacy. He did it with tariffs. He has officially threatened a 10% flat tariff starting February 1st on 8 key European allies: Denmark, Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland. And then he added the real knife twist. He warned those tariffs will jump to 25% by June 1st if a deal for the complete and total purchase of Greenland is not reached. So you've got this situation where the US is basically saying to Europe, help us get Greenland or pay a tax for doing business with us. And Europe's response? Not calm. European leaders, with Macron out front, are already discussing retaliatory anti-coercion measures. That phrase matters. Anti-coercion. It's basically the EU saying, if you push us, we're going to push back, and we're going to use the full toolkit. And the market heard that and translated it into one sentence. NATO and EU-US trade relations might be heading into a real breakdown. And when the West starts fighting itself, money doesn't sit around and meditate about it. Money runs. It runs to what it trusts. It runs to what is outside the political system. It runs to what can't be printed, frozen, or negotiated. Gold, yes. But today, silver acted like the lifeboat, because silver is not just a shiny rock anymore. Silver is industrial survival. Silver is green energy. Silver is electronics. Silver is military tech. Silver is the metal that quietly sits inside the stuff that keeps modern life running. And that's why this $94 print is so important. It's not just a price, it's a signal. Now, let's break down the perfect storm that created this move. Force number one is the Greenland tariff bomb itself. You have to understand what tariffs do to psychology. A tariff is not just a tax. It's a message. It's a declaration that cooperation is being replaced by leverage. And the second you hear 10% February 1st and 25% June 1st, your brain doesn't think, oh, that's a minor adjustment. Your brain thinks this could spiral. Because if Europe retaliates, it hits supply chains, it hits currency pairs, it hits growth expectations, it hits debt costs, it hits corporate earnings, it hits politics. And in that kind of environment, investors start asking a very simple question. What do I own that still behaves like a safe asset if the rules of the game change? That's the first push. Now, force number two is the one that makes this whole thing feel like a structural event. The physical run. This is the part that paper market people hate talking about. There's a structural credit crisis unfolding in the metals world where big money is losing faith in paper promises, and they are demanding physical delivery. And when that happens, the market changes character, because the price you see on a screen is not the same thing as the metal you can actually get in your hands. If you've been watching silver for any length of time, you've heard the argument, paper claims versus physical supply. But today, that argument stopped being a Twitter debate and started looking like behavior. Reports are coming in that COMEX inventories in London and New York are being depleted at record speeds, and whether every rumor is perfect or not, the direction of the pressure is clear. People are treating paper exposure like a seatbelt that might be fake. They want the car, not the insurance brochure. Now here's the number that should make you sit up. Lease rates. Physical silver lease rates have spiked to an unprecedented 8%. That's not normal tightness. That's panic pricing. Lease rates are basically the cost to borrow physical metal. So when lease rates go vertical, it's a signal that the people who need actual silver, like industrial users, refiners, and manufacturers, are getting squeezed. They're not saying, it would be nice to have a little extra inventory. They're saying, we need it now. And once you have industrial demand competing with investment demand, in a market where the physical float is smaller than people assume, the price can become extremely emotional. That's exactly what a vertical move looks like. Now, force number three is the supply chokehold, China. And before you roll your eyes, listen. In a move that coincided with the Western tariff news, China has implemented a new export licensing framework that effectively restricts something like 60-70% of the world's silver supply to their domestic market. If that's even partially true, it changes the map. Because Western solar and tech companies don't have a magical backup planet where they can source metals at will. They compete for what's left. So imagine the setup. The US drops tariff threats on 8 European allies. Europe starts talking retaliation. Markets start pricing a political fracture in the Western alliance. At the same time, physical silver starts getting pulled out of the system. And at the same time, a major supplier tightens the export valve. That is a perfect storm. That is how you get 94. Now I want you to picture what explosive actually means here, because words get cheap online. This wasn't a slow staircase. This was a trap door. One moment, silver is trading like a normal hot market, and the next moment, it's ripping higher in chunks, like someone is hitting the buy button with a hammer. Spreads widen, quotes blink. People start refreshing their apps like it's a playoff game. And the weirdest part is the silence, because when it's happening, you don't hear the reason yet. You just see the effect. That's how you know it's a shock. In a normal rally, the story arrives first, then the money follows. In a shock, the money moves first, and the story chases it. That's why so many people are waking up to the headline after the move already happened, feeling like they missed something. You did, but you can still understand it. So let me translate the mechanics into human language. When Trump threatens tariffs on Denmark, Germany, France, the UK, and the rest of that list, it's not just Europe will pay more. Its supply chains will get uglier, companies will race to reroute inventory, governments will posture, and currencies will start swinging. And once currencies swing, metals don't just move because of demand, they move because of stress. Stress is a buyer. Stress is the investor who says, I don't know what's coming, but I want something real. And silver, when it's tight, becomes the most dramatic version of something real, because it has less depth than gold. It can't absorb panic as smoothly. It whips. Now, about that anti-coercion language from Europe. This is important because it tells you the mood. It tells you Europe isn't trying to quietly de-escalate. It's preparing a framework to hit back in a structured way. Think counter-tariffs, restrictions, targeted measures, and the kind of policy tools that turn a negotiation into a standoff. So when the market hears anti-coercion, it hears this could get official. And official conflict is where safe haven psychology goes from hobby to necessity. Now, let's slow down and talk about the physical side again, because this is where the story becomes more than politics. People ask, what does COMEX draining even mean? Isn't that just internet fear? Here's the simple version. COMEX and London vault systems are basically the plumbing of the Western paper market. They're where a lot of deliverable metal is counted, moved, pledged, and borrowed against. When inventories fall fast, it means the system is being asked to provide more metal than usual, and it's doing it. But the key detail is the difference between metal that exists somewhere and metal that is actually available for delivery right now without breaking something. That's why you hear people talk about registered versus eligible. Eligible is metal that meets specs and sits in a vault. Registered is metal that is tagged and available to deliver into contracts. When stress rises, the market cares about registered, because registered is the you can have it today pile. And when that pile shrinks, paper starts looking like a claim on a smaller and smaller pool. Now imagine you're a big player. If you believe the pool is shrinking, you have two options. You can hold paper and trust that the pool will be there, or you can demand metal now and remove your trust from the equation. That second behavior is what turns a tight market into a run, and this is where lease rates become a siren. An 8% lease rate is basically the market screaming, borrowing physical just got expensive. Normally, in calm times, you might see lease rates around a fraction of that depending on conditions. So when it jumps like this, it tells you there's immediate demand to borrow real metal, not because it's cute, but because somebody has an obligation. Deliver to a customer, feed a manufacturing line, meet a contract. That's why industrial users panic. A solar manufacturer cannot just say, oh well, we'll wait for next quarter. An electronics supplier can't tell a major customer, sorry, we couldn't get silver, try again later. They pay up. And that's how the metal turns into a bottleneck. Now layer China on top. If a new export licensing framework is truly restricting a majority share of supply into the domestic market, then Western buyers are competing over a smaller slice of the pie. And that's not theoretical. Silver is not optional for modern tech. It's in high-efficiency solar cells. It's in EV components. It's in data centers. It's in defense systems. It's in medical electronics. It's in things that governments and corporations consider non-negotiable. So you end up with a weird new reality where silver is both an investment asset and a strategic input. And that creates a different kind of buyer. Not a buyer who says, I think it's undervalued. A buyer who says, I need it and I need it before my competitor gets it. That kind of buyer doesn't wait for the dip. That kind of buyer creates the dip. All right? With that foundation, the big question becomes, what happens next? And yes, gold moved too. Gold is up around $4,660 in this story, but silver is the headline because silver is the one that behaves like a coiled spring when the physical market tightens. Now let's talk about the speed of this. Silver is up about 31% in the first 19 days of 2026. Let that sink in. We are not talking about a slow grind higher. We are talking about a market that is repricing itself in public. And whenever a market reprices itself in public, the question becomes, is this a bubble or is this the new floor being built in real time? Here's how I'm thinking about it. There are two stories that can be true at the same time. Story A, there could absolutely be a pullback. In fact, some analysts are already floating a pullback zone around $84, and that would make sense mechanically because when something goes vertical, it usually needs to breathe. Traders take profits. Weak hands get shaken. Momentum cools. Even in a real bull market, the path is never straight. But story B is the one people underestimate. The macro backdrop is not normal, and silver's role is changing. Silver is starting to act like geopolitics in metal form, and that makes it harder to just pull back and chill. Because when a price is being driven by fear of a breakdown and by physical stress, the dips don't always get the time you expect. They get bought, fast, especially when the next round of news is already scheduled. Think about it. February 1st is a real date. That's when the 10% tariff threat would begin. June 1st is a real date. That's when the 25% escalation threat sits like a guillotine over the table. So the market is not just reacting to something happened. The market is reacting to something is set to happen. That creates a forward panic. Now add to that something most people missed. Silver was added to the U.S. critical minerals list last year, and that matters because it changes the political calculus. If silver is essential for green energy and the military, it becomes strategic. And once something becomes strategic, the old playbook of just suppress it becomes complicated, because if you push the price down too hard while the world is screaming for supply, you don't just hurt speculators, you hurt your own strategic infrastructure. So the tension becomes, do you manage price or do you secure supply? And if the system chooses supply, price can do wild things. Now let's zoom in and describe what today felt like, because this is important for understanding where we are emotionally. This was not slow money. This was urgent money. This was where do I hide money? When you see silver move like this, it's not only new buyers showing up. It's also existing players changing their behavior. It's hedgers adjusting. It's shorts covering. It's industrial users paying up. It's funds reallocating because their models just got slapped. It's the market collectively realizing that the old assumptions might be wrong. And when assumptions break, price gaps. That's why a 60-minute window can do what a year normally does. Now, I want to make this practical because drama is fun, but you're here to understand what to do with this information. So here's what I'm watching next. First, watch the currency pair, USD versus Euro. If Europe retaliates hard, you're going to see stress in that pair. And when currency stress shows up, metals often catch a bid because they are the escape hatch from currency volatility. Second, watch the language coming out of Europe. Words matter. If you start hearing anti-coercion instrument, countermeasures, retaliatory package, strategic autonomy, those are escalation words. Those are words that say, we're not just angry, we're preparing. Third, watch the physical signals. Premiums, delivery times, dealer inventory. If you start seeing out of stock everywhere, that tells you the physical market is tightening faster than the screen price is reflecting. And then, if you can, watch the indicators that normally whisper before they scream. Lease rates, obviously, but also backwardation, spreads, and the behavior of near-month contracts. When the market starts paying you to deliver sooner, that's a hunger signal. Fourth, watch COMEX-like inventory headlines and the sentiment around registered versus eligible stocks. Even if you don't live and breathe those categories, the simple idea is this: how much metal is truly available to meet delivery demands? If that pool shrinks while delivery demands rise, price becomes less about charts and more about availability. And availability is ruthless. Now let's talk about the psychological trap that most people fall into at moments like this. The trap is the all-in at the top impulse. Because when you see $94, your brain starts doing this. If it hits $100, I'll feel stupid for not buying now. That's FOMO. And FOMO is how you donate money to the market. So here's the balanced way to think. If you already have a position, especially physical, this move is not a reason to panic buy more at any price. It's a reason to understand your time horizon. Are you a trader trying to catch a wave? Or are you a long-term holder using silver as a strategic asset? Because the strategy is different. Traders need risk management, stops, position sizing, a plan for a pullback. Long-term holders care more about the bigger map, supply, demand, monetary stress, and geopolitical fracture. And right now, the bigger map is screaming. But that doesn't mean the market can't punch you in the face in the short term. So if you're buying here, you need to be honest about your reason. Now, I'm going to say something that might annoy the most bullish people. A pullback would not invalidate this story. In fact, a pullback could be the market building a stronger base. Because vertical moves are unstable. They need structure, they need time, they need the market to accept the new level. So if we do see $84 or $86 or even 80 something, the question isn't, is silver dead? The question is, does physical stress ease or does it tighten? Because if the physical stress tightens, dips become temporary. If physical stress eases, then you get a deeper cool down. That's the framework. Now let's imagine the bullish scenario because you need to understand the upside risk. What gets silver to triple digits? It's not one magical headline. It's a chain. Chain link 1, Europe retaliates. Chain link 2, the tariff war becomes a broader trade war. Chain link 3, growth expectations drop, currency volatility rises, and safe haven flows accelerate. Chain link 4, industrial users front-run supply because they're terrified of not having metal later. Chain link 5, paper holders look at the delivery stress and start demanding physical, or they rotate into anything tied to physical. Chain link 6, the market realizes that $100 isn't a ceiling, it's a psychological checkpoint. Then you get the headline, silver hits $100. That headline is a magnet. It pulls in the late crowd. It forces more covering. It forces more hedging. It forces more attention. And that's when things can get chaotic. Could that happen by the end of the week? If the political escalation accelerates, it's not impossible. But I'm not here to sell you fantasies. I'm here to map the battlefield. And right now the battlefield is made of dates, supply, and trust. Now let's address the skepticism, because you should be skeptical. Whenever a market moves like this, there will be people saying it's a squeeze, it's a mania, it's a meme, and sometimes those people are right. Sometimes the move is driven by leverage and forced buying. But here's the thing. Even if leverage is involved, leverage doesn't create the underlying vulnerability. It exposes it. A squeeze only works if the system is already stretched. If there's plenty of metal, if there's plenty of liquidity, if everyone trusts the pipes, squeezes fizzle. When squeezes turn into events, it's because the pipes are narrow and the trust is thin, and today felt like trust thinning. Now I want to talk directly to the people who are new to silver, because if you just joined this world, it can feel like everyone is speaking a secret language. Comics, lease rates, registered, eligible, backwardation, premiums. Here's the simplest way to understand it. There's the price and there's the product. The price is the number on a screen. The product is the metal you can actually get. In calm times, they behave like they are connected. In stressed times, they behave like they are two different universes. And today was a stressed time. So the question you should ask isn't, did silver hit $94? The question is, why did it have to? Because if the market was relaxed, it wouldn't have to gap like this. It would drift. This was not drifting. This was urgency. Now let me give you a practical checklist of what to do right now, depending on who you are. If you're already holding physical silver, take inventory, literally. Know what you own, where it is, and why you own it. If your purpose is long-term protection, do not let short-term noise shake you. But also, don't let euphoria make you reckless. Decide in advance what price would cause you to take some profits, if any, and what price would cause you to add. Write it down. Because in a fast market, your brain becomes your enemy. If you're holding paper exposure like ETFs or futures, understand your counterparty risk and your liquidity risk. I'm not telling you to dump anything. I'm telling you to know what you own. In a stressed environment, paper instruments can behave in ways that surprise people. If delivery stress is real, the paper market becomes a narrative battleground. So manage your position like it can move $10 in a day, because it can. And there's one more indicator I'm watching that doesn't get enough attention: forced behavior. When markets get this hot, exchanges can raise margin requirements, brokers can tighten risk, and funds can delever without warning. That kind of mechanical selling can create ugly pullbacks even in a bullish story. So if you see a sudden slam lower, don't automatically assume the narrative died. Sometimes it's just plumbing again. On the flip side, if you see the pullbacks getting bought within minutes and physical premiums refuse to cool, that's the market telling you the stress is real. That's why I keep coming back to one word: trust. Do people trust the paper claims? Do they trust the alliances? Do they trust the supply chain? If trust keeps eroding, the price can keep climbing even when it feels irrational. One surprise headline can flip this fast: a tariff delay, a back-channel compromise, a sudden "we're negotiating" press conference. That would cool the panic for a moment. But if physical tightness stays, the calm won't last, so treat every dip and rip as information, not a command. Stay sharp out here. If you're not in silver at all, but you're watching this, do not chase. Make a plan. Maybe you dollar cost average. Maybe you wait for a pullback. Maybe you buy a starter position so you're not emotionally naked. But do something intentional. The worst place to be is frozen, because the market doesn't wait for you to feel ready. Now, quick mid-video moment here. If this breakdown is useful, and you want me to keep tracking this Greenland tariff situation and what it's doing to silver, hit the like button, subscribe, and turn on notifications. Because this story is moving in hours, not weeks, and I'm going to keep calling out the levels, the dates, and the signals as they happen. All right, back to the map. Let's zoom into Greenland for a second, because people are going to say, why does Greenland even matter? Greenland matters because it sits at the intersection of security and resources. Its geography, its minerals, its control of routes, its leverage. So when a superpower starts talking about complete and total purchase, it's not just a real estate headline, it's a power headline. And when Europe hears that, they don't just think about Greenland. They think about sovereignty. They think about precedent. They think about what happens next. And that's why the EU is discussing anti-coercion measures. It's a defense reflex. And markets, when they smell defense reflexes, start pricing instability. Now add China into that same moment. If China is tightening export licensing and keeping a bigger share of silver supply domestic, it's a strategic move. It's not just business, it's supply security. And when multiple major blocs start acting like resources are strategic, the world shifts. We move from global market to managed scarcity. And managed scarcity is rocket fuel for metals, especially metals that sit inside critical technologies. Now, here's a nasty possibility that almost nobody wants to say out loud. What if this isn't just a price spike? What if this is the market discovering the true cost of silver in a fractured world? Because the old world assumed smooth trade, stable alliances, and predictable flows. If those assumptions die, the valuation framework changes. It's not about what was silver worth in 2019. It's about what is silver worth when supply is gated, alliances are tense, and the physical float is being hoarded. That's a different equation. Now let's talk about the endgame risk, and then I'll close with the question you should ask yourself tonight. The endgame risk is that this becomes a self-feeding loop. High prices trigger more hoarding. More hoarding tightens supply. Tighter supply pushes prices higher. Higher prices trigger more panic buying from industries that can't shut down. And then the paper market gets stressed because the physical reference point is moving too fast. That's when you see extreme volatility. That's when you see days that feel like earthquakes. And we might be entering that phase. So what do you do with that? You stay calm. You stop reacting to every tick. You zoom out to the signals that matter: politics, physical stress, and supply control. And you remember the simple truth. The market doesn't care about your feelings. It cares about the next marginal buyer and the next marginal ounce. Now, last thing, because I want to leave you with something practical. Ask yourself this. If silver pulls back to $84, would you panic or would you see it as a chance? And if silver pushes to $100, would you chase or would you stick to your plan? Because the people who survive volatile markets are not the people with the best opinions. They're the people with the best process. Today was a warning shot. The Greenland tariff shock is here. The Western alliance is showing stress lines. The physical market is flashing red. China is tightening the valve. And silver just broke $94 like it was nothing. So here's my question to you. Are you still buying at 94 or are you waiting for the dip? Tell me in the comments because I read them and I want to know where your head is at in this moment. And whatever you do, keep stacking, keep thinking, and keep your eyes on the dates because this story is not over.